Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance. And on this episode, we're going to discuss tariffs and inflation. Jobs bounce back in November. We're going to take a look at how IRS and Bitcoin income, how it needs to be calculated, and a look at the Plan Solutions Incorporated Office Bulletin Board. Mr. Armour, how are we, good sir?
Just, trying to get into the holiday spirit, but it's a little cold and rainy and, still got a fair amount to do before the holidays.
I understand. I can relate. Well, we got some great topics we're going to dig into. So let's jump into tariffs and inflation. Let's start off by clarifying what tariffs are.
So the tariff is basically a tax that a country applies against goods that are being imported into their country. Right. So, bottom line, if a U.S. company wants to buy something from China, in the process of it being imported, going through customs control, et cetera, there's a tax that's applied that U.S. company would have to pay for those goods to be released into the country. At their base, it's going to increase costs of certain goods, and typically that tax or that cost will be passed on to consumers. And obviously, there's been a lot of talk about trade policy and things since the election. So we thought it was, kind of worth touching on the impact that those tariffs or that tax may have, and show that, it will have an impact and generally a negative impact on, business activity or inflation. But a lot of what we're seeing and hearing is implying that impact is going to be much greater than it actually is likely to be.
Yeah, well, I think it continues to be, we talk a lot about the headlines and how it's put out there, potential tariffs, huge increase on all your goods. And it's not always the case because, you give a great example of talking about NPR's Planet Money podcast, where they talked about the purchase of a cookie in a New York City bakery. And it's interesting when we hear these things like tariffs on all these goods, we forget that sometimes it's not the end line item that we are purchasing. Sometimes those goods that are coming through that might have a tariff are just one element of that end product.
Exactly. Yeah. There's a lot of other economic and financial factors that go into this, right? And so when you hear, a blanket 20% tariff, the idea is the cost of everything's going to go up 20%. Well, of course, first of all, tariffs are just applied against imports, and imports are about 14% of the U.S. economy. The U.S. is actually very fortunate in that we are probably the one country that is the least dependent upon trade. When you think about a lot of countries have to import all of their energy. We have a lot of energy resources. A lot of countries have to import a lot of food, and we are basically food independent, right? So many things that especially our necessities, the U.S. is independent or very close in those areas. So we're not as reliant upon imports. And then the financial factors of just how tariffs work their way through, right? You have to think it through, and it's going to affect different goods or different items differently. So we give three examples. So the first you alluded to, NPR's Planet Money did a podcast where, they bought a cookie at a boutique bakery in Manhattan. And they went through and they said, okay, half of the ingredients of this cookie are imported. And so therefore 20% tariff would drive up the price. And I thought it was a little disingenuous that they didn't take it to the next step and say, okay, what does this actually mean for consumer prices, right? They're just leaving this big 20% number hanging out there. And I started thinking it through and I thought, okay, at a bakery in Manhattan, if you go get this kind of artisan cookie, I'm thinking of even places like that my daughter loves here in Sacramento, right? I mean, you're paying $3 for that cookie. But if you boil it down, the ingredients for that to make that one cookie may only cost 30 cents, if that. And so if we say, okay, ingredients cost 30 cents, half of it is from abroad, that means only 15% is really the cost that's being imported. A 20% tariff on 15 cents is only going to be a 3% tax or a 3-cent tax. So if you're increasing the cost of that cookie by 3 cents, by the amount of that tax on a cookie that retails for $3, this is a scenario where a 20% tariff may only have a 1% impact on end consumer prices.
Right. Yeah, it's really minimal, and I think it's really great that this was brought forward because I was actually having a discussion with someone that this at work, and there's the other areas that I work in, and we do receive a medication, and we don't know where it's been, and it's like it very little of it's really going to impact us. At the end of it, the reality of it is that just the only portion of it is the plastic packaging that wasn't made here in the U.S. as far as the import. So it was really quite timely that you bring this up. It's well, you've given other great examples here too.
Yeah, another one. So it really comes down to the baseline of trade, which is the comparative competitive advantage. That's kind of how an economist would look at trade between two countries. And, let's say China has a competitive advantage in, making a certain good, and they're able to make it 3% cheaper, even after you factor in, obviously the increased shipping costs, right, to get it from China to the US. If a company can save 3%, right, they're going to outsource to China. I mean, why wouldn't they, right? Why would you turn down an extra 3% profit margin? Or if you didn't do that, then your competitor probably would and would be able to underprice you, right? So you'd almost have to do it to stay competitive within the US market. But in that case, if there was a 20% tariff placed on that item, what you'd likely see is that production would shift to the US.
Mm.
Now, granted, as we said, US production is more costly. So you'd likely see the price of that good go up 3% in that case, just to reflect the higher costs of manufacturing it or producing it in the US. But that 20% tariff is not going to result in a 20% price increase. It's going to result in a 3% price increase because China's comparative advantage is not 20% or greater, right? It's much smaller, which for a lot of goods and services is likely the case.
What about situations in which where the cost of imported items is a large percentage of the consumer price, and the U.S. may be unlikely to be able to produce that item anywhere but abroad?
Yeah. So that's what I would call the worst case scenario, right? When it comes to a tariff or a trade war. And so in this case, let's assume China, as an example, has a really large competitive advantage, right? They just can produce it so much less expensively than we can here, that it's really not an option to shift production back to the US, even if a 20% tariff is applied. Well, then you still have to look at the difference between cost of goods sold and the final retail price to get an idea of how that would play out. So an example I use is like the dollar stores. We saw a lot of the dollar stores, their stocks really got hit following the election results because of this concern, right? That a lot of the things, the inexpensive items, kind of mass produced, doesn't take high quality labor or anything to produce it. A lot of that comes from China and is what they sell at those stores. But as an example, if it's a dollar store, let's say there's an item that they sell for $1. Well, obviously in retail, you typically have a 100% markup, right? So they may be paying 50 cents for that item. So if you put a 20% tariff on that 50 cents, that's going to add 10 cents. So now the company may have to pay 60 cents for that item. And then if they want to make the same 50-cent, gross profit margin, right, from which they got to pay, a lot of, their expenses and taxes and interest payments, and then, profit at the end of the day, they would have to add on that same 50 cents that they were before. So now your cost of goods sold would go from 50 cents to 60 cents. you'd maintain the same 50-cent gross profit. So now that item, instead of retailing for $1, would have to sell for $1.10. So again, the worst case scenario here is that we have a 20% tariff results in a 10% price increase. So you can see how, so many different goods could be impacted in different ways. But, none of them really coming to that level of seeing a full-on 20% of the final retail price being passed on to consumers.
Yeah. Well, and of course, I think, going through all we have with inflation and cost of living, I can see the trepidation, though, for so many to worry about even higher prices coming, but it may not be as much as often advertised, and that we're kind of being told in a good blanket statement or the catchy headline.
Yeah, I think it's just important to be, realistic about these things, because obviously you want to be working with good data when making financial decisions or investment decisions. And you're right. I mean, any price increases are going to be unwelcome, coming out of the period of high inflation that we had, and inflation's much lower, but it's still kind of stubbornly in that 2.5% range, and we'd like to have it a little bit lower. But I think, if you look at 20% tariffs, if you figure, okay, maybe the real adjustment there is maybe around 5% across those items, and it only affects 14% of our economy. So only 14% of our economy is seeing a 5% price increase. Obviously that gets down to, something that's going to be well below a 1% overall impact. In fact, I saw, one estimate. I'm not sure quite where they got these numbers, but they were saying that 20% blanket tariff would increase consumer costs by $87 billion, which sounds like a really large amount. But then when you start thinking, but wait a minute, $87 billion on a $30 trillion economy, it wouldn't even be noticeable in the aggregate.
Right, right. Anything else you want to add before we jump to jobs bounce back in November?
Well, just that kind of in the scenarios that we laid out, in the aggregate, it would likely be a small impact, but it will affect certain areas, certain industries, and certain prices. It may be more noticeable. So obviously, those are implications that need to be taken into account when we kind of look at investment sectors and decisions on the investment side.
Yeah, that'll be interesting to dig into a little bit later on, hopefully in one of the personal financial reviews. All right. Well, the U.S. added 227,000 jobs in November, which exceeded the average expectation of economists and reduced fears that the job market may be weakening. What do we see as far as adding new jobs and the unemployment rate?
Yeah. So in October, we saw a little bit of a dip in the market, and you could argue the October jobs report was part of that, because it came in really disappointing. Initially, they reported only 12,000 jobs added in October. It was recently revised up to 36,000, but still well below the monthly average for the year. And so obviously that's going to catch people's attention, and they're saying, okay, is the job market maybe starting to slow? Or are we starting to see some cracks here? That could be a concern. Now, the market didn't move too much. I think there was a lot of people are saying, well, the October jobs report was negatively impacted by two factors. First was the Boeing strike, right? I mean, that's just a large employment pool that was not working. And then also Hurricane Helene that hit, big part of the Southeast, and obviously the recovery and everything that was happening there, U.S. jobs really took a big hit. So it was very comforting to see in November that the economy added 227,000 jobs, right? We saw a strong bounce back from that weak October jobs report. We also saw the unemployment rate tick up a little bit from 4.1 to 4.2%. Obviously, that's a very low rate, so it's very positive. And actually, the unemployment rate ticked up slightly because the labor force was expanded. So we're seeing, more people wanting to get jobs, more job openings expand. Often that can lead to unemployment ticking up a little bit in the short term, but is actually a strong sign of a strong economy and a strong jobs market.
Yeah, yeah, absolutely. I mean, it's really positive data around some of the fears about the job market going forward. Now, of course, it begs a question, or at least my curiosity around it. It is that time of year, going out to the big box stores and everything else. Is some of this potentially just seasonal jobs, or does the report clarify that no, these are career-based positions for people maybe going into more long-term employment?
Well, you can see, I mean, total non-farm jobs will include seasonal jobs. Yeah. So, but these numbers are seasonally adjusted. So I guess the way to put it is if we looked at the raw data, you would see these seasonal spikes, right? But what they do is, they take kind of the normal historical pattern and seasonally adjust the data. So, it might tell you a little bit like if this seasonal employment was a little better than the norm, right? Then you'd see some movement. But you're not going to see, the seasonal differential being the 227,000 because they're comparing it to the same level of seasonal employment from last year and the years prior.
Gotcha. Okay. I was just curious about the data collection, if it was, year over year or quarter to quarter. So thank you for the clarification. Anything else that you would like to add before we jump to IRS and Bitcoin income?
Well, just the other positive sign is the JOLTS report, which is an acronym for Job Openings and Labor Turnover, also shows increasing job openings. So that's a good sign, right? The jobs are available, labor demand is still high, and we're seeing job growth as a result. Usually that JOLTS number is kind of a good forward-looking indication of labor because if there's a lot of job openings this month, it could mean there's a lot of jobs filled next month.
Yes, sir. All right. Well, let's take a look at IRS and Bitcoin income. It was part of the headlines about Bitcoin soaring after the election. I mean, reaching some all-time highs. But some interesting things are happening for sure. I've kind of followed this. Some investors post-election after those gains, it's time to walk away. But they got to keep in mind when it comes to tax season, capital gains, and so on.
Exactly. Yeah. Yeah. Bitcoin, like any other asset, right? If you sell it and it's at a gain, then it's either a short-term or a long-term capital gain, and that needs to be reported on your taxes. Now, the challenge is, digital currencies, and depending on what medium people are using to be able to, introduce cash into that system or pull cash out, the reporting can differ greatly, right? And unlike a lot of more conventional investments where there's standardized reporting, it's sent out, it's pretty easy to either enter or download that information onto a tax return. In a lot of cases, people will find when they sell their Bitcoin, there's no tax report that's issued, and they actually have to go back and try to track those different lots or do the calculations themselves to figure out what they paid for a specific lot or what their average is in terms of what they paid, and then of course what they sold, and be able to go in and properly report that on their tax return.
Yeah, I'm curious about the perspective of a short term or long term, and what maybe that difference in calculating that is, and maybe the impact upon taxes. If for example, if somebody put 2,000 in this year and got 4,000, and put maybe it was years ago put 2,000 in and got 4,000 when they sold this year, is there really any difference when it comes to uh, that their taxation once they make that decision to sell that asset?
Yeah, well, short term is if you've held it for a year or less, then you're taxed at ordinary income rates, which can be, quite high. If you've held it for at least a year and a day and sold, then it's long-term rates where you get a preferential rate. That, depending on the person's overall income, could be very low or could be more of a moderate type tax rate. So it can make a very big difference. And as you bring up, there can be challenges in keeping track or properly reporting this because, yeah, let's say you purchased 2,000 years ago, and you purchased 2,000 earlier this year, right? So you have a total of 4,000 invested, and now your total holdings are worth eight, and you sell 4,000. You sell half of it. Well, which portion did you sell? And how do you properly document that, right? So that's part of the challenge when there's not automatic tax reporting from a custodian or something like that. And there are certain rules as to how those calculations need to be done. So, the individual may need to understand that process and how it's calculated. The other thing that is very important that a lot of people maybe skip over is now on a tax return, there's a question that asks if someone received, sold, exchanged, or otherwise disposed of a big digital asset. And it's a yes or no checkbox, right? And so if someone did, they need to make sure that they check yes on that box. The worst thing that could happen is that you forget to report your Bitcoin transactions because you didn't receive any tax forms or anything to make it top of mind. And then as you go through those questions, you just let it default or you click no. Because not reporting those gains is potentially tax evasion. And the way our tax law works is to get someone for tax evasion, the U.S. government has to show that they willfully attempted to defraud the U.S. government. And that willful part is always the difficult part, right? They have to show that it wasn't just a mistake. This was your intention to try and cheat on your taxes. Well, that box, if you check no and you don't report it, right, they've got you. They show that you were willfully admitting it and they even reminded you and you skipped over it. So it's important that you check that box yes if you had any of these transactions, and then of course obviously make sure you report them as well.
Yeah. Anything else you want to add before we jump to the Plan Solutions Incorporated Office Bulletin Board?
Well, just the normal tax mistake often can be corrected. You might have to pay interest and penalties, but if they're able to show that willfulness and tax evasion, that's when you're looking at the potential for jail time. So all of this kind of area of digital currencies and things that are decentralized and kind of off the grid, that appeals to a lot of people, but then they maybe don't realize the importance of the extra responsibility they have to protect themselves.
Yes, sir. Don't let me forget to check that box this tax season, Chase. All right. I'll remember, but you remember better than I do. All right. Well, let's jump to the Plan Solutions Incorporated Office Bulletin Board. We got one item pinned up there this week. What is it?
Yeah, so this is an area where we've seen a lot of enforcement, and it's something that it seems like we're reminding clients of a lot. I get it's not front of mind for them, but it's something that we have to be really aware of, which is the Securities and Exchange Commission really doesn't allow financial planners or investment professionals to communicate via text messages or really any type of medium that can't be captured and stored, right? Where there's records of a conversation or communication. But it's been a real area of emphasis for the Securities and Exchange Commission. They've levied fines from $250,000 to millions against financial firms just because employees answered a text message from a client, right? And even sometimes about very simple things. So, while we agree, we think this seems excessive, especially given that text messages are becoming a very common form of communication. But it's just an example of where government regulations often don't keep up with societal changes. And, often, unfortunately, rather than trying to figure out adjustments or ways to deal with it, they just levy bigger and bigger fines. So we just want to, remind our clients that, unless the message is of a personal nature and doesn't have any reference to business, because of the high degree of risk of large fines, Plan Solutions, our employees and team members, may not be able to respond to messages via text message. So if really need to talk to us, or if there's important instructions or, something, it's email and telephone is still the best way to communicate. And obviously we want to remind these people because we don't want a poor, client service outcome or something like that, just because of the form of communication, which the regulators really just disallow.
Yes, sir. Absolutely. Well, how would you like to close up this episode? I mean, by the time this comes out, we're looking at Christmas and heading towards the new year.
Yeah, I hope everyone has, wonderful holidays, wonderful, safe, happy holidays.
Yes, absolutely. And same for me to you and yours. And thank you for listening to Plan Solutions Incorporated podcast, of course, on Apple Podcasts, Spotify, where you can leave a rating, a review, maybe share with somebody else that will get value out of it. And if you'd like to watch along to the Personal Financial Review, the content that Chase and myself discuss here on the podcast, you can do so on our YouTube channel. That's youtube.com/Plan Solutions. Get subscribed today. And if you have yet to subscribe to the Personal Financial Review, it is simple. Just send Katie an email and get subscribed. It's KATIE@plansolutions.com.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.